Is Elon Musk going to dismantle the SBA, or as he likes to call it, the shady business administration? Or is it correct, like he says, only 9% of SBA loans actually get paid back? The answer is no. So the default rate on SBA 7A loans, which is kind of the traditional, most popular loan program for the SBA, it's usually in the low single digits. It can vary by year, but usually you're looking between 2 and 5%. Much different than the 91% default rate implied by Elon. Now, I think he's confused because he's looking at the pandemic era programs that were not really loans. Most of those were forgiven. They were never actually intended to be loans. They were always essentially giveaways. Now, for his comment that the SBA is shady, it's hard to buy that given how rigid the program is and how difficult it is to get an SBA loan. A lot of people complain about how hard it is. I mean, we have a business helping people get loans because it is hard. If it wasn't easy, people wouldn't need help with it. So obviously that shadiness, it's hard to really, say that that's true or that they're giving away money, giving away the taxpayers' dollars. But we are hearing there's some changes coming. Now, for background, the previous administration lowered the down payment requirements for an SBA loan. So technically they kept them the same. They always required 10%. But before, only 5% of that could come from the seller, and it had to be on standby for the entire life of the loan, meaning no payments of principal or interest while that loan's outstanding. So they relaxed that portion of it. So you still need 10%, but the seller, in theory, can make 100% of your down payment. And so they can do that either by rolling equity or by seller financing with a 24-month standby. So the rules changed from the seller only being able to cover half the down payment to now 100% of the down payment, and the standby note having to be the full life of the loan to now only 2 years. Now, there has been some rumbling that those changes are leading to higher default rates in SBA loans. I don't really buy it. Defaults are a little bit higher, but it seems to be more driven by interest rates and normal economic factors, the same things that drive defaults in the high yield bond market or other credit markets are affecting the SBA loans. So it's hard to say that change in the SBA loan is driving that change in defaults when we're seeing that change in defaults across the entire spectrum of credit, even loans that have nothing to do with the SBA. But some people are saying that. Sometimes it doesn't matter if it's true or not. If the right people start saying it, you could see changes to the rules. So there is a potential that we'll see some tightening up and some increases in the down payment requirements. One thing we are hearing from our banks is that they're much more focused on post-close liquidity. And it seems that it's somewhat of a front-running a change that they think is coming in the regulations. Because really the way regulations happens is a lot of times the banks ask for these rule changes and then eventually they comply. So the banks want to see borrowers have more liquidity post-close. So we heard from one bank, they really tightened up a lot. They said they want to see the borrower have 10% of the purchase price just sitting in the bank account as post-close liquidity, which typically, that's a good amount of cash to have after a loan closes, but usually we get that cash from a working capital loan so that the buyer doesn't actually have to bring that much cash to the table. They're saying they want to see that cash come from the borrower, not from a working capital loan, which that would be a huge tightening of credit and would make getting a loan much more difficult if that change were to happen. So we really hope it doesn't. And then another change that seems pretty obvious that this probably is going to happen is the prior administration removed the guarantee fees for loans under $1 million. So typically when you do an SBA loan today, you pay a guarantee fee. So that's between 0 and 3.75% of the loan balance. And essentially that money goes into the fund to cover any losses to the SBA. So that way that the SBA runs as a neutral program. They don't cost taxpayers anything. They're essentially self-funded. So since the SBA is funding itself through those guarantee fees, loans under $1 million are more likely, they're the most likely to default. Actually, the larger the loan, the less likely they are to default. Essentially, you're not charging the guarantee fee on the loans most likely to default. It's great for helping the little guy, but at the end of the day, it really doesn't help the SBA program. It puts the SBA program in a bad situation because they're not taking in the money that they need to cover the losses, increasing the likelihood that they would need some type of bailout or government intervention to cover losses if something were to go bad, which I think would hurt the program as a whole. So the healthier the program is, the better. Probably one thing to help the health of the program is to bring back the guarantee fee for loans under $1 million. that's not going to have a big impact on the market. Those fees get rolled into the loan anyway. So of course it does mean when you take out a loan, that's more you'd need to pay back, but the market is going to survive that change. So even though that's one that looks pretty likely, it's definitely manageable. Overall, we're just going to have to wait and see. Generally, we think that the administration is going to be pretty favorable to helping small businesses. I do think they want to make sure that the SBA is a healthy, viable program. So, we might see some tightening of requirements and underwriting, but hopefully it's not going to be so drastic that it has a major impact on the market.